Right, good morning, everyone. Ben Seeger-Scott here. Welcome to the latest Forvis Mazars economic and investment update. As usual, we'll be going through the pretty standard agenda you're hopefully used to by now. I will start off talking about markets. That's going to be pretty brief because I want to get into the meat of the presentation. But I'll do a little bit on markets. Then George Lagaris, our chief economist, will go into more detail on some of the fundamentals, some of the economic background, and really a deeper dive into what we're seeing from our sort of house view. Then I'll pick up on the latest changes. As you hopefully know, we rebalanced our portfolios last month. So I just want to talk about some of the trades that we made and the reasons for those. And then there's a Q&A session at the end. So if you do have any questions, we have some that are already submitted that we'll look to pick up. There's a Q&A box at the bottom, so we will pick those questions up there and George and I will answer them depending on where they relate to. So if we go to the next slide, please, Zach, and the next one again, just talking about markets. I show on this slide, it's the same one that I will try to use each time for consistency. It's the year-to-date return of major markets. It's in sterling terms, so it does account for some of those currency effects. And I think it's fair to say a lot of the talk over the last few weeks has been focused on politics, on the UK budget and the US election. But I think it's useful to take a step back and look at how markets have done throughout this year. And you can see that gold's continued to perform really strongly. And actually, we will touch again on that in the portfolio activity section because we've had some activity on the gold exposure in our portfolios. But gold has continued to rally for quite surprising and non-intuitive reasons. And developed markets, the dark blue line there, the second highest performer, developed markets have continued to do pretty well overall. US equities have done well in the wake of the US election, but actually markets broadly have ticked up throughout this year. There hasn't been a huge one-off effect. Instead, the business environment has continued to be supportive. This path to a soft landing where central banks and governments have been able to have high interest rates, bring inflation under control, and now start cutting those interest rates without causing a recession. It was a tough ask, but so far that narrow pathway continues to be tread. And I guess particularly from the election, equities have had a boost in the last few weeks. A double positive really for companies, particularly in the US. The prospect of cuts to corporation tax obviously means if you cut corporations tax, the earnings, the net earnings go up, and that's obviously directly positive for equity prices. Also, some of the stimulative capability of personal tax cuts could help buoy the top line, so revenues as well. So a bit of a double positive. And sort of the one other thing I will say about the outcome from the election, regardless of which way your personal politics may lean, markets at least have reacted positively to the clarity. There was some potential that if the vote was very close, if there was the likelihood it would be a little bit more protracted, that could lead to a protracted period of uncertainty. The mere fact there's been a clear answer allows markets and businesses to say, okay, here is the outcome and let's adjust for whatever future that may be. So the clarity in and of itself has been positive. So gold and developed market equities benefiting. The areas that have come under pressure has been emerging market equities that have struggled. But again, you can see it wasn't the election itself or those political events that caused that downturn. From sort of late September, early October, some of the shine has been coming off, particularly as China has continued to struggle economically. And you can just about see, it's not obvious from this screen, but I know George will talk about it a little bit later. But government bonds have come under pressure as well. Still positive for the year overall, but a little bit of a tougher environment, partly because the expectation of higher growth and a bit higher inflation means interest rate expectations have adjusted accordingly. But I will leave George to talk about that specifically. I will just touch on inflation and bonds on the next slide, though. And there's only one point I want to make. I'll just wait for the slides to update. Here we go. George has a version of this slide that he will use to talk around some of the other impacts. But what I wanted to show here, we haven't looked at bond yields explicitly. Instead, we're looking at what the market is implying interest rates in the US at the end of next year will be. It's a little complicated, but we try and say how many cuts do markets think are going to be in play in 12 months' time. And that's the dark blue line. You can see a lot of cuts were expected earlier this goes from the summer, which is where we have the earliest implied rates. You can see there was quite a lot of cuts sort of priced in, and since then the number of cuts have reduced. US interest rates are currently at around 4.6%. So you can see even now there are still cuts priced in, but less than there were. And some of that may or may not be the impact of the elections. I'll let George talk about that more. What I want to talk about, that bottom blue line, this is average expected inflation over the next 3 years. I've used a 3-year measure because on the 1 year you get these base effects, you get high prices low last year coming to low prices this year. And as that window moves through, you get some artifacts from things like energy price caps and so forth. Using a 3-year measure smooths some of that out. And the point I wanted to make, this is the expected average inflation for the US over the next 3 years. And hopefully you'll recall in some of our earlier communications and in some of our earlier webinars, we said over the summer that market expectations that inflation will drop below 2%, that's that target level over the next 3 years. That seems overly optimistic. We do see inflation coming down from the very extreme levels we've had. We think it is likely to sit somewhere above target. Most central banks have a target of 2%. We think maybe 2.5% to 3% is more realistic. We talked about that earlier in the year. We talked about these inflation expectation levels looking a little optimistic. And you can see there from about the middle of September, those inflation expectations have crept higher. And it's really, to a greater or lesser extent, that's what has been driving a lot of the bond price movements over the last sort of 2 months or so. So I'm not saying that politics and other influences haven't had an effect, but I don't want people getting the impression that the election happened and suddenly bond prices jumped up, the UK budget as well. It wasn't the case that they jumped up. It's the case that since September, expectations of inflation have been normalising more towards our house view, and that has caused, to at least some extent, bond prices to rise. And I think often we can get sucked into this assigning single reasons for markets moving, but actually it's quite a broad area, broad exposure that we look at. And that's why we will always come back to, we'll talk about specific topics, particularly if you ask us, but it's always important to take a step back and consider the broad environment that we're operating in. On the next slide, I think I now hand over to George. George is going to talk about economics in a little bit more detail. In particular, what I think is relevant from some of the things we've seen more recently is what's this mean for the longer term debt and interest rate environment. Like I said, it's not one specific thing, but George will hopefully give you an idea of the broad range of factors that we are considering. So George, over to you.
Thank you, Ben. Sorry, struggling with the buttons here. By the way, a slight mistake in the heading. We moved the risk from even to elevated, not the other way around. Just before we start, I want to put something out of the way. There is always going to be some sort of crisis. There is always going to be some sort of thing that will spook markets. We have grown accustomed in the last 15 years of the Fed suppressing risk so much that now we have become a lot more sensitive to risk, and I think that was to be expected. So I hear all those scenarios flying out, and just before we start, I have a number I want to share with you, and the number is 4.5%. That is exactly how much the US stock market lost in the 13 days of October 1962, the Cuban Missile Crisis, when the world was literally, very literally, in fact, threatened with total obliteration. It was a 4% drop in the stock market. So that doesn't mean it was the risk wasn't real or that markets are crazy. It means that markets are not the place where those risks will necessarily be reflected. And here, this conversation is about markets, it's about economies, and it's about the portfolios. Okay, so let's keep that in mind. Now, why is risk elevated? China is slowing down, we know this. Inflation around the services sector is sticky, so basically we're just waiting for China to deflate the world in terms of goods, so we can tolerate higher inflation in services and still see interest rates down. The geopolitics are not getting any better, and there's no point in getting into the details of that. But what really moved the needle was the last two bullets, the higher rate trajectory to which Ben alluded, i.e., Mr. Trump's election, other things being equal, suggest markets that we could see higher growth and higher inflation, which means higher rates going forward. And markets are very sensitive about rates, much more so than geopolitics, and also very high US equity valuations. US equity valuations are now, by many accounts, similar to where they were in 1998. Having said that, what keeps us generally not upbeat necessarily, but not panicking, is the fact that those valuations are concentrated in a very small number of stocks with high capitalization that push the whole stock market up, whereas the rest of the market is still expensive, but not so frothy. So we moved the needle to elevated risk, just not super elevated. Okay, and please keep that in mind because there is a difference between the two. Next slide, please. Now, and of course, this updates on almost a daily basis. Stocks are up roughly to 20-21% since the beginning of the year in dollar terms. Ben showed them to you in GBP terms, and bonds are down maybe now 1%, 1 to 1.5% since the beginning of the year. The chart, maybe just a couple of days old, and still you get those slight discrepancies. But the one thing we have to understand also is that those markets are not independent. The reason stocks are rallying is the assumption of more fiscal outlays by governments, especially the US government, especially after the election, which is good for stocks because more economic growth, good for equities. It's bad for bonds because it means more debt issuance, so larger supply of bonds, which should, other things being equal, reduce their price, and also some fears now that are finding their way into the bond market that debt is too high. And we're going to talk about this because we are seeing a plan to address this. Next slide, please. As Ben said, a different version of my slide, a different version of his slide. This is where investors expect rates to be at the end of 2025, around the 3.75%. This is a far cry from the 2.75%, which they expected in the middle of September. So the result of the American election added about 1 percentage point in interest rate expectations. Higher growth, higher inflation, higher rates, good for equities, bad for bonds. It's really a very simple story. Next slide. Now, again, on the backdrop of more borrowing to finance this, the US is expected to grow. Let's look at next year. I think this year is mostly done. Is expected to grow by 2.2% this year. The UK is expected to grow by 1.5%, and Europe seems weaker. So these are IMF expectations. Each set of bars is a different outlook. So we start from January 24 and we ended in October 24. So in its latest version, the IMF said the US is going to grow much faster than we expected, and Europe is going to grow less than what we expected. So the IMF acknowledges, generally speaking, as the US picking up and Europe pulling back, and it is precisely also what we're seeing in the day-to-day macroeconomic data. Again, there are no surprises here. Next slide, please. Now, what keeps things good and afloat is that there's a lot of liquidity out there. And on the left-hand side, you can see the velocity of money measured by M2 or M4 in the UK, which is a better metric for this particular country. And as we can see, with the exception of China, things are pulling up. But China was already there, so it's still good. So there is monetary expansion, good, very good for growth, very good for businesses, very good for your portfolios. And credit impulse is also improving, i.e. the creation of new credit. We can see this especially in the US and the EU on the right-hand side chart. Next slide, please. Now, as we said, and this is, this has to be understood. Yes, we're growing in the US faster than expected, but it is built on debt. Okay, we're not growing because just on some previous policies, the CHIPS Act and all that. We're growing in the Western world in general. If you look at the long-term growth trends, the reason we're growing because demographically we've stopped growing, at least not in a pace that supports 3 or 4% growth, economic growth per annum. We are growing because of that. Productivity is not there yet. So, AI hasn't given us that silver bullet quite just yet. And as we said, demographics are a little bit horrible in Western economies. So it's that countries are running big deficits. Okay, and yes, they have pulled up a little bit since COVID, which pushed the averages down, but still deficits are way over the 3%, which is considered a norm. Okay, the US is running a 6.5% deficit. So it is the goal of many countries to reduce those deficits. Okay, but how can you keep growth up if you don't improve the rate at which people are having babies, and if you don't, AI doesn't give you this big productivity boost? How can you improve growth if you're reducing your deficit? Next slide, please. Yet the situation is pressing. The blue bars are GDP growth. The green bars are interest payments compared to GDP. So, for example, the US grows by roughly 2% per annum, and it's paying roughly 4.5% per annum to pay off its debts. That's not sustainable. And France is growing by 1%, and it needs nearly double that to pay off its debts. The UK, not nearly as bad, but it still has a bigger interest rate payment schedule than its growth. So with the exception of Germany, most of the debt out there is not sustainable. So we need to do something. And next slide, please. So we're going to, I think, we're going to go back to an old trope because this is a cycle. Following financial crisis, there are huge bank bailouts. Banks promise not to do it again. We shackle them with rules, and then the government takes on debt repayment. It's concomitant with banking crisis like the one we saw in 2008, that government debt expands to cover a lot of things in the economy that banks used to do, and also to pay off for the bailouts. But there reaches a point when government debt is too much and the banks are very well capitalized. So politicians might say, well, okay, that's enough now, and we regulate banks enough. Now we need to open them up a little bit to foster growth without too much stress in the in public spending, because the state cannot keep borrowing at those rates. Okay, bond markets are getting jittery, and we can see that. So the next step from this, and this is a very big key takeaway from this presentation, is that we seem to be approaching a break point for bank deregulation. Scott Bessent, Mr. Trump's pick for Treasury Secretary, has been a fervent advocate of deregulation. Rachel Reeves spoke twice about the need for regulators to accept more risk. Okay, she wasn't shy about using her words either. So, and Lagarde, Christine Lagarde, the head of the ECB, warned that the US and possibly the UK will deregulate the banks, and that will be a challenge for the EU. So I don't think the EU will have any choice but to follow. So we're looking to change the previous trend. Banks, very well capitalized, might start lending out more. The pace of deregulation will determine when the next banking crisis happens. If things are deregulated too quickly, like they were hastily and quickly deregulated in the US peripheral banks, you could see a banking crisis within the next 2 or 3 years. If they're regulated in a more paced way, it could be anywhere from 5 to 20. So keep that in mind. Bank deregulation does come with a cost. More often than not, that cost is an ensuing banking crisis. But at this point, markets are pressing governments to stop borrowing, so something needs to be done. And it seems very likely that governments are going to go towards that direction. Next slide, please. Now, the second key to growth, as we said, the first one is debt, and the second key to growth is China. China is responsible for a lot of the world's growth anyway. It is still the world's second biggest single economy. It's still growing possibly at a pace of 3 to 4%, maybe 5 as they tell us. But we do know from various indicators that we use, like iron ore imports, copper demand, oil demand, container throughput, steel prices, and industrial profits, that China has not been growing very much. Okay, now this is good and bad for us. It's good in the sense that it keeps inflation down, because, next slide, please. On the right-hand side, you're going to be able to see China's factory goods, the inflation for Chinese factory goods, down to maybe 3% per annum. So goods are deflated because China is throwing a lot of cheap stuff, especially in Europe and the US up to a point. But the services inflation, services account for 70% of the economy, and these are your light blue bars, is well ahead. It's from 4 to 5% and well ahead of the 3% about average where it's supposed to be. Still, this allows central banks to lower rates because China is deflating the good parts, the goods part of the inflation. But it may come at a cost to growth. Now, before I go, the Chinese stimulated their economy circa by 1.4 trillion a couple of weeks ago. Obviously, this could help with growth, but it could also boost inflation up if the deflation part in goods is reduced. So all in all, we are seeing a world that grows a little bit faster. We are seeing a world that's a little bit more inflationary. Good for equities, not so good for bonds in this particular case. And as for the geopolitical stuff, most of that stuff has already happened, and a lot of the really, really bad stuff, the really, really bad outcomes, is not a question for portfolio management. And with that, I think I can yield the floor back to Ben.
Thank you very much, George. So in this next section, I'm going to talk a little bit about our portfolios. And I think we talk a lot on these webinars about here's what's happening in markets, here's a lot of our deeper thinking, and George has really well outlined some of the other points that we're thinking very deeply about. But for most of our clients, it comes down to, well, that's great. What are you actually doing in our portfolios about it? And everything we try and do, all of the output that we talk about on here, which itself is just a tiny fraction of what we cover every week in our investment meetings, all comes back to the guise of how do we use this to benefit our clients the most, and how do we use that to advance our portfolios. So I will just touch on some of the rebalances that we've made, or some of the changes we made at the rebalance. And I've got one slide later on performance, because it's good to talk about, but I think we've had enough elsewhere in this webinar that I'll probably do a deeper dive in the next webinar on the sort of multi-year performance. But in terms of the changes we made, there were 4 changes this time around, 2 more significant ones, 2 relatively minor. It's the significant ones that I'll dwell on in the next few slides. But just to touch on the changes that we made. Previously, as you know, we've made a few more changes in the equity portion, exiting some of that US value previously, adding to Japan. We talked about that in some of the earlier webinars. This time we've looked more at the non-equity elements. And what that means, earlier trades tended to mean a little bit more in the higher risk models and less in the low risk, because the high risk models have more equity. These impacts tend to have more of an effect on the lower risk portfolios that have more non-equity exposure. So don't want you thinking we're making a huge number of changes each time. But the 4 changes, in one instance, we've exited gold. So we no longer hold gold in the portfolios. We're taking some profit, adding to US Treasury inflation protected securities. I will talk more on that shortly. We've also exited our high yield bonds, and we've put that into emerging market local currency bond. Again, I'll talk about that in a moment. The 2 I won't dwell on unless there's a lot of questions about it in the Q&A. We made a small change within our government bond fixed income exposure. We did have dedicated US Treasury exposure. We've swapped that into a global bond tracker, which basically means that small element of the portfolio goes from being all in US Treasuries to now about half in US Treasuries, other in developed market equities. And partly that's trying to diversify away from having just exposure within that instrument to the US. Also within sustainable funds, Mirabaud Sustainable Global Focus, that fund manager is leaving. So we've just split that exposure across the other funds that we do have conviction in. So those are the relatively minor ones. I will talk about the asset allocation changes starting on the next slide, where we've exited gold and added to US Treasury inflation protected securities. Now, I apologize, compared to the last presentation, when we talk about changes to Japan, it's relatively explainable. Both of these trades are a little bit more technical in nature, so please do bear with me. And as always, there's 2 legs to a trade. There's what are we selling and why? What are we buying and why? And starting with the gold price, gold has done extraordinarily well over the last few years. You can see in the chart on the top left, this is the gold price going all the way back to 1974. And you saw on the very first slide we had today, the huge rise in gold this year that makes little fundamental sense because gold has yields exactly 0. So typically one thinks if other bonds, government bonds, the so-called risk-free rate has a positive yield, why would you be rewarded for holding something that has no yield? To a greater or lesser extent, it's rising geopolitical fears. Gold is often used, I think Warren Buffett coined the phrase, it's a way of going long on fear. And there's been lots of things to worry about. But also we've seen central banks buying. The Bank of China in particular has been buying large amounts of gold. Partly this is trying to diversify their balance sheets. There's a general sense they don't want as much sort of US Treasury exposure as they've had in the past. An increase in gold exposure gives them a diversification benefit, and that's been driving a lot over the last few years. But as we look at it, you know, the gold price is high. It's very difficult to value inherently. That's one of the troubles with gold. It doesn't have a cash flow you can look at. It's not based on an economy like a traditional fiat currency is. So it's difficult to say, is the economy going to do well or less well? There's no central bank that controls it. So you don't have any real fundamental basis upon which to base your valuation. What we do know is the price is high in absolute terms compared to history. Another way of looking at it on the bottom chart, some people give more weight to this, some people give less. But if you look at it adjusted for inflation, it's now above all of its previous peaks, even adjusted for the impact of inflation. Obviously, some people choose to look to gold for inflation protection characteristics. If you do an analysis, the correlation is weak. People use gold for a lot of other reasons, but those are typically why people look to the yellow metal sometimes. We've chosen to exit largely because we don't think the buyers are going to carry on buying. Core to our thesis of carrying on to hold it at the high levels was the fact that central banks were continuing to diversify their balance sheets. What we've seen throughout this year, demand outside of investments, and investors are inherently price sensitive. Outside of investments, demand is falling off. Jewelry demand has continued to fall throughout this year. Crucially, central bankers have reduced their purchases. Indeed, one of the news reports that we looked at that really made us think this trade is worth doing is that the the People's Bank of China has halted purchasing of gold since around sort of April, May time. And that's as the price went through 2000, through to 2,200. It's now hovering around 2,700. We think that's very high. We think even if you're a central bank is looking to structurally diversify the balance sheet, if you're a central banker, if I was a central banker, I would probably say yes, on a 5 to 10 year view, we want to diversify. There's probably going to be an opportunity to top this up when it's not at 2,700 and potentially more when it gets closer to 2,000. So I think because those price incentive buyers, particularly central banks, have stepped away from the market at these levels, we don't see this price as being particularly attractive, and we take this opportunity to take profit. Crucially, though, we're not saying that's it, gold is done forever, we'd never touch it. I think it's specifically taking profit at these elevated levels and looking for an opportunity to re-enter the market when prices are look more reasonable, because we do believe in the long-term structural growth rationale for gold. But it's very specifically taking profit. The other side of this trade is buying what are called US TIPS. Those are Treasury inflation protected securities. They're hedged back to sterling, so we don't have the currency exposure. And we've kept the duration a little bit lower. That's the maturity. So we're generally buying bonds that mature in about 4 or 5 years rather than 10 years, which is typically the benchmark. And there's lots of reasons wrapped into this as well. We think moving from gold into something that could be more protective of wealth is attractive. You get a reasonable yield off the back of it, as sort of George was showing how we see the government bond market more broadly. Wrapped within that, we've gone for that lower maturity, lower duration, because we do have some concerns at the longer end. If governments do have to borrow a huge amount, that tends to put more pressure at the longer end. So by bringing that maturity profile down, we have less exposure to the area most sensitive to continuing debt issuance. And also, as I talked about on inflation, we prefer the inflation protected element simply because it doesn't guarantee that you're immune from movements in inflation. What it does mean is it's mitigating against rising inflation expectations. And as we talked about earlier, we've consistently said we think inflation will settle in the 2.5% to 3% range as its sort of base level. And when we saw those inflation expectations below 2, we thought those were too optimistic. So using Treasury inflation protected securities means this exposure is mitigated, so yields will not rise as much if it is inflation expectations driving those changes. If central banks start talking about real yields rising, so yields, interest rates not falling as fast as inflation, then that can have an impact. But here we think if inflation expectations do normalize, there are lots of good reasons to buy US TIPS, as they're called. Like I said, a little bit complicated, but hopefully you can see there's a reason that we're wary of gold, central banks stopping buying, and there are some technical reasons, a series of good reasons to be buying US TIPS in their place. So that's the first trade to talk about. On this, the next slide, we can talk about this second trade, and this is going from global high yield to local currency emerging market debt. What does that mean? Well, high yield bonds are bonds, so loans to companies, and we distinguish in investment terms between investment grade that are relatively safe and most people think have a high chance of paying you back, and high yield, which is also called junk bonds, which are junk rated, which means the market thinks there is a higher risk that they default. And again, there are two legs to this trade. I would say both are in the higher risk part of fixed income. So fixed income has lower risk elements and then higher risk. This is effectively nuancing the exposure we have in the riskier part of fixed income, where we're willing to take a little bit more risk to generate more return within the overall blend. And one way to look at high yield bonds, in fact, all corporate bonds, is the spread. What you can see on here, again, slightly complicated, but this is the spread above government bonds. So this is the additional yield that the market pays you for taking the additional risk of corporate bonds and the risk of these bonds defaulting. And you can see on the left-hand side, I'll sort of move through them. Apologies that we have the investment abbreviations, We've got US, IG and triple B. These are both investment grade bonds. You've got emerging market IG, that's again investment grade. And you can see across the piece, you're not really being rewarded for taking risk. And then the fourth one along and the fifth one, this is US high yield and then Euro high yield. And in each case, the blue band shows over the last roughly 10 to 15 years, I think it is, this is where that spread, that additional compensation yield being offered has been. So that's the full range over the period. The light blue line is where the average is, and the average tends to be relatively low. The reasons that the bands are wide is because you have these spikes whenever there are shocks. But the blue bar shows where the average spread should be, and the light blue diamonds at the very bottom show where the spreads currently are. And I can abbreviate all of this by saying, in our view, you're not being adequately rewarded for taking the additional risk you have with these bonds. And yes, the yields in absolute terms might look attractive, but what this tells us, the market is pricing in a very optimistic scenario. And if we do see defaults starting to pick up, and we think defaults are more likely when interest rates are higher and perhaps aren't falling as quickly as we think, you're simply not being rewarded for taking risk in this part of the market. We reduced this last time. We have talked about this before, so we're already a little bit underweight. Now we've gone sort of doubly underweight and closed out our high yield positions. On the next slide, though, I talk about the other leg, and everything that when you're talking about the riskier parts of the market, you've really got to focus on, are you being rewarded for taking these risks? In a multi-asset portfolio, we have low risk assets that are designed to provide some level of risk mitigation and level of protection in portfolio. And then we look to the riskier parts to generate a return. And we always want to make sure we're being paid for that return. And here we look to local currency emerging market debt. This is government bonds of emerging markets. There is South Africa, there is Colombia, a whole bunch of others that are emerging markets, but they are relatively high quality. And here you can see this line shows over the last sort of few years, the dark blue line and the light blue line is Europe and the US. These are aggregate indices. They're mostly government bonds overall, though. See that teal line, that much higher. These are emerging market government bonds. But actually, the rating on these are generally considered in aggregate to be investment grade. So long story short, the yields in emerging markets look pretty attractive. Emerging markets have much better financial institutions. They are much more stable than they have been in the past. And you're being rewarded pretty heavily for taking this additional risk. There's a little bit of currency exposure wrapped in as well. But overall, we think the risk return characteristics are better in emerging market local currency than high yield. Another way to look at it, high yield, its credit rating is relatively poor. In emerging market local currency, you're getting a higher yield and a better credit rating. The average credit rating for emerging market is investment grade, whereas by definition, the average rating for high yield is junk rated, and you're getting a better yield. So you really are, I think, being rewarded for taking risk in this area. So that's the other reason for that second half of the trade. If we go to the next slide, please, Zach, I think now we're very much into wrapping up territory. I just want to talk a little bit. Here's where our portfolios currently are. As we said, we are now, if you look down to fixed income, we're now underweight global high yield. It's an area we think you're not being rewarded for. We've got that overweight to emerging market bonds that I talked about, and now overweight to UK government bonds. We include US tips here because it's hedged back to sterling. It functions very much like a government bond. So that's where we're choosing to tilt our portfolios. You can see there we've now exited our gold positions. And we are, as we talked about before, whilst we're underweight North America, that's specifically by being underweight small cap and value, we're still focused in the US on those growth opportunities. And those are the areas that continue to benefit from the rally that we're seeing. So overall, our focus in the US is to keep exposure, neutral exposure to those growth names and be underweight those other positions. The next slide, we'll talk a little bit about performance, but as I said, I'll touch more on this next time, but I think it's always worth touching on it a little bit. What this chart shows, all of our portfolios are bucketed by an external group called ARC, Asset Risk Consultants. That's shown in the grey bar in each sort of grouping. This is just year-to-date performance. Next time I'll talk about our 3 and 5 year performance, which continues to be very strong. In each case, you can see the blue line shows how our portfolios are doing. Our core portfolios, the green bars show our sustainable portfolios, and the grey bars show the average of the peer group. And at the low level in defensive compared to the cautious ranking, you can see we're slightly lagging the peer group. But again, our defensive portfolios are designed to be even more defensive than the peer group. So we're not surprised when markets are rallying that we would lag a little bit, because here we look a lot more at trying to preserve capital and grow it in line with expectations. But we are lagging the peer group that's taking a little bit more risk. Hopefully you see the higher equity risk buckets. Both our core and sustainable portfolios are continuing to deliver as we expect. So still very happy with our performance overall. So if we go through the next few slides, we can wrap up there. So in conclusion, overall equity markets continue to do well. The US election result has proved positive risk assets, whilst bonds have softened. Debt is stimulating economic and market activity, but if it builds up in the long term and isn't carefully managed, it can store up problems for further down the road. But that's not something that markets, particularly equity markets, are thinking about at the moment. We made a couple of changes to our portfolios: gold to US Treasury inflation protected securities, and that high yield bond into emerging market local currency bonds for the reasons we talked about, and performance remains strong. And now we'll move to the Q&A. We will just flash up over the next 2 slides. We will share these, or these are available upon request. We always have the topical cheat sheets, because often clients say, oh, you haven't thought about this or talked about that. We think about a huge number of elements. Only some of them justify inclusion in our actual house view. So if you want to think about geopolitics, the election and the budget, we think about all of those. And here's a few one-liners. The next slide has a few more as well. So we do think about the oil price, we think about AI, even crypto. We have thoughts on all of them, but don't want to talk about them each time. So with that, I will open it up to any questions. So if we go to the next slide, I think has the questions. We've got a few that have been answered live, and then we'll attempt to pick up some that we have already loaded in. Let's start with debt. There's 2 that I think we can wrap together, both from Nick. The first one is, as I understand it, GDP includes government spending. So is GDP growth really a good thing to pursue so desperately, George? And related, Nick also asked, can countries continue to increase debt levels incessantly? So George, is GDP growth a good measure, and can countries continue just to
think
up debt?
okay, so I think that the answer veers on the philosophical a little bit. Is it worth growing if you grow on the basis of debt? And the answer would be, economic theory would tell you yes, it's always better to grow even on debt than not to grow. And I think 40 years of Japan showed us just this. In fact, if anything, Japanese debt to GDP is at very high levels. And it's not like they were funding growth. So lack of growth does not help you with your existing debt levels already. Governments are not stupid. They might borrow more, and borrowing has accelerated, to be sure. That is why they will try to find the medium to short term silver bullet in asking banks to shoulder some of the burden. There was a second part of this, Ben?
Yes, around how long can countries continue to increase their debt levels?
It depends on the country. So theory tells us that emerging market countries may fail at, and may experience a debt crisis at 55 to 60% debt of GDP. Japan has over 200 debt of GDP and has not experienced a debt crisis because 95% of that debt is internal. So in essence, if internal debt really is a transference of taxes instead of It's a deferral of taxes. Instead of increasing taxes, we ask who wants to lend us. It depends on the country and it depends on the on the debt profile. So there's no clear-cut answer to this. But what you need to do is rank who's the weakest and who's the strongest. And the strongest is definitely the United States, despite all the debt, because they have the world reserve currency. Personally, apart from emerging markets, which are always at some sort of debt risk, I would argue that European countries, where responses from the central bank can be cumbersome at times of debt stress, are at the most risk, and due to the incomplete banking union. And this is echoed by Christine Lagarde in a speech she gave last week.
Great. Thank you very much, George. I will then turn to a question we already had come through from Mike, and it also touches on John's live question. So I'll read them both out. I will answer them, but I think they lead on nicely. So Mike asks, with world debt over 3 times GDP per person, so it ties in with the debt concern, geopolitical tensions, Trump tariffs, signs of deglobalization, BRICS moving towards outside USD, central banks buying record levels of gold. Long story short, where do we see the future of gold, silver, and other metals over the next 5 to 10 years? Particularly seeing about high inflation. Is it the most palatable way to inflate away the debt? Whereas John takes the slightly different view. Oh, sorry, I'm imposing it my own view. But John says interesting observations with regard to gold. It seems to me that the rationale for buying, selling are not dissimilar to cryptocurrencies. No yield, simply betting on the price others are prepared to pay, and our thoughts. So I think hopefully I've answered to some extent Mike's question live, which is I do think structurally there is a tailwind for gold, which there hasn't been before, which is why I don't think simply saying the price is high, as all humans, we are programmed to think in terms of mean reversion, what goes up must come down. So we see it high in nominal terms and think it'll go back. I think the trajectory is probably towards higher gold, but I think there is going to be a cycle sort of within that, and there are going to be expensive points and not expensive points, which is why, I'd be willing, all else being equal, to consider re-entering the trade if it just drifted back to what would still be considered relatively high levels. I do take John's point that, the trouble with gold, it has no yield. All you're doing is buying something at a price that someone else wants as well. What I would say, though, is gold is actually used as a real asset, and central banks, there's some excellent research from the Gold Council we also spent a lot of time poring over when we were reviewing this trade idea. And central banks tend to have a particular need for gold, because if you're a central bank, you need reserves with which to underpin your currency. And if you run out of reserves, your currency can get into trouble very, very quickly. And actually, a lot of central banks around the world, the US has huge amounts of gold in reserve still. Other countries do. The UK sold a lot under a previous government, which came under pressure at the time. Other countries have less. China has less and is looking to add more. But effectively, you need some sort of real asset. And that's what central banks are looking for. If you have currencies, if your reserves are in currencies that other central banks can change the value of by changing their interest rate policy, central banks can devalue a currency by just printing a huge amount more. So your risk, if you're a hypothetical investment bank holding sterling, dollar, and euro, the value of those can be devalued if those central banks just print a lot more of that currency, which is why central banks look for a real asset that no central bank can print more of. There is a control of them. And that's why people use gold. It could be any other real asset. It could be another commodity. And that's why sometimes one looks at the price of gold versus something like oil or something like house prices, because they're compared to other real assets. But if you're a central bank, you want a real sort of tangible asset that isn't tied to a central bank. They like gold because its value per unit per ton is one of the most efficient ways to do it. You're exactly right that there is no fundamental valuation behind it. Cryptocurrencies have some similar characteristics insofar as there's no underlying cash flow or yield to look at. But what I would highlight is, gold has been performing this function for many thousands of years, and central banks, even today, you can go on the World Gold Council that canvass all the central banks and say, what's your rationale for buying gold? And up there will be hedge against geopolitical shocks, diversifying portfolios, and mitigating hedge exposure. So it is not the most fulfilling analysis I've ever done, looking at what do I think the rationale of buyers are rather than a fundamental base case. But it does have, I think, a small, it does validate a small position in portfolios. It'd be rare that I advocate huge positions because it's difficult to value. But I think simply those typical investment characteristics that have been validated over hundreds, if not thousands of years, hopefully validate its holding at some level. We touched on in that question tariffs, so maybe I can pick up Ian's question and then bounce it straight to George. George, what effect will Donald Trump's proposed tariffs on China, what effects will they have, do you think?
Okay, first we have to remember that there is a distance between what Donald Trump declares, what will eventually happen, and the negotiation in between. It's a very typical way, archetypical way, I would argue, of negotiation, to take an extreme position and be ready to move more towards the center as long as you get some concessions on the other side. Okay, now having said that, and let us assume that the tariffs are implemented in their entirety, it could have devastating effects to the global economy, and I do not use the word lightly. The last times the US imposed such tariffs on the world was 1930, right after the Great Depression, the so-called Smoot-Hawley Act, because Mr. Trump also intends to go through Congress, which is going to be the second time since 1930, so nearly 100 years. And this puts the tariffs on a much more solid ground. The last time, theory argues that it significantly accentuated the Great Depression. So all other things being equal, those tariffs implemented could have significant negative impact on growth. Initially, it could lead to higher inflation and thus higher interest rates, and then it could start killing off growth. But I think, keep in mind that I think those extreme positions are not necessarily the end policy. I don't know, Ben, would you agree with those comments? Do you have different thoughts?
No, I think that's fair, and I think the key point to hold on to is we need to wait and see what is said, what has been stated on a campaign trail, and what happens once you're in government needs to be carefully watched. So it could tariffs generally, and anything that is grit and friction in trade in the global economy could cause problems. But I think we need to see what is actually implemented, not just stick to what's been stated. So there's still everything to play for. On those, we've got 6 minutes left, and we still have quite a few questions to get through. I will go quite quickly through some of the pre-submitted questions. 3, which I think I can summarize in 2. One is from Nick. A year ago, with the promise of reducing interest rates, overweighting funds in bonds looked attractive. What's the current outlook for such funds? I think it comes back to what's priced in. I think we're looking at interest rates falling not quite as quickly, but still falling. Still a relatively positive environment. I think that a negative environment for bonds will be if there's an inflation shock and you see very sharp sell-offs. And we've talked earlier about some of the mitigations we're trying to have within that. But I think it's important to remember a 10-year government bond is currently yielding you about 4.5%. And even if inflation is at 2.5%, that's still around 2 percentage points each year above inflation that you're being offered for these. And that will just accrue. So even if bonds are completely flat, even if the price doesn't go anywhere, you're still getting a 4.5% yield. And that can actually help you manage through quite a lot of pain. Unlike go back 5 or 6 years when you had a yield of virtually 0. So you needed positive price movements to make any sort of return. So I think the outlook for bonds is fine. It's okay. We have some tactical overweights and some underweights within that. But overall, I think we're back at a neutral, but with the outlook perhaps cooling, I'd be reluctant to get too enthusiastic. But I think they can go back to performing their basic operation in portfolios. The next two are government related, and I will keep it relatively short. Wiles asked, controversially, do we think business owners have been hung out to dry by the government, meaning something unfair has been meted out to people that haven't done anything wrong? And Mukesh asks, how do you see the UK market perform after Labour's budget in 2024? I would just say for both of those, the thing to remember, we are apolitical. We simply look at policies. Fairness or otherwise is a political matter and ultimately down to the electorate. What I would like to focus on is there has been a budget. Its impact on the market has been limited. Borrowing was slightly higher than expected. It has pushed yields up a little bit. But actually, most of the budget announced thus far has been around shifts within relatively personal and some indirectly personal through corporate tax implications. It doesn't change the overall macro environment or indeed the wider UK economic environment at the moment. The two things to remember, I would say, is that the government itself is going through a periodic comprehensive spending review, and we're still waiting for the government industrial strategy that's being consulted on. And I think those two elements are likely to have a much bigger medium-term impact, and we will get the results of both of those next year. So the budget has been very much a political event around largely personal taxation, and we have other seminars on that. I think we need to wait and see what comes out of the industrial strategy to take it further. George, one for you, and then one for me, and then we probably do need to wrap up. One from Neville. George, do you have any sense how long the bull market will run?
No. And I'll be honest, if I did, I might not have been employed for a living. The background would have been my own private island. Okay, having said that, I think that if bank deregulation cometh, and that is a big if, I think that could potentially unleash forces for a new cycle. So, after you get at some point a correction, because we do need one, we haven't had a proper correction in quite some time. But after you get the proper correction, the next cycle of the bank deregulation could be a very strong cycle. So I don't know how long this is going to last, but I'm telling you, I do expect a correction, and I do expect a bullish cycle thereafter on strong growth and bank deregulation.
Great. Thank you very much, George. The last 2 minutes, there is one from Catherine on the implications of inheritance tax and stamp duty. We will pick that up separately because there's another seminar that covers that, so Zach can signpost that to you. The last question I'll pick up in the last 60 seconds is from Les, that says, US asset class is still significant in our portfolios. The main industries equity investment is comprised of. We take a diversified position, so we have dozens, if not hundreds of companies in fact, hundreds of companies in the US. So it is broadly diversified. The US market, as you know, is heavily exposed to IT, but also industrials, consumer discretionary and consumer cyclicals. So we do pick up from the US a reasonable amount of technology, but it's not exclusively technology. So we do still have a broad diversification by sector, and we would be wary of too much exposure to any one sector. That is pretty much our time. So I'll just thank you all for listening. Thank you all for the questions. And we very much look forward to talking to you again next time if we don't have an opportunity to speak to you in between. Thanks very much all. See you all soon.